Home office is one of the deductions coaches most often leave money on. The reason is half perception and half procedure. The perception is that the deduction is suspect or audit bait. It is not, when claimed correctly. The procedure is two calculation methods with different complexity and different downstream tax consequences at sale. The unit covers both the rule that gates everything and the documentation that holds at year 3. Three things kill this deduction before it starts. Assumed audit risk, the belief that the simplified method gives you nothing, and a casual definition of what counts as the office. The deduction is not suspect. The IRS publishes two methods because both are accepted. The disqualifier is not the math. It is the room itself failing one test. Get that test right, and the math is straightforward either way. Regular means used for business on the normal cadence of the work. Most weeks, not most months. Exclusive means no other use at all. A spare bedroom with holiday decorations stored in the closet fails. Those decorations are personal use of the same space. A dedicated coaching room with the door closed during client calls, prep blocks, and admin time passes. The standard does not bend for the gray area 5% of personal use you might be tempted to overlook. Personal use is cumulative in the wrong direction. One piece of evidence is enough to disallow, but auditors look for a pattern that confirms the first piece. A family member's email logged into the office computer. A gas bed pushed against the wall in the photo from last Thanksgiving. The Roku in the office showing a personal Netflix profile in the watch history. The disallowance is binary on the evidence, not on the percentage of personal use. If you measure the room, multiply by 5, and stop there, you have done the entire calculation for this method. No depreciation schedule, no utility allocation, no recapture exposure when you sell the house. The trade-off is the ceiling, $1,500 maximum, 300 square feet maximum. For a coach with a 10 by 12 room and rent under $30,000 a year, this is usually the right choice and the lowest overhead choice in the same election. Actual is potentially higher, but the cost shows up years later at a sale. The arithmetic is straightforward. Business square footage divided by total square footage gives you a percentage you apply to mortgage interest or rent, utilities, insurance, repairs, and depreciation if you own. The catch is depreciation recapture. Every year you depreciate part of the home for business use, you reduce the basis. At sale, the IRS pulls that depreciation back at ordinary income rates. Run the actual method only after a CPA has walked you through the recapture cost. The decision rule. Office under 300 SQF and Simplified gets close to 1,500. Take Simplified. Actual percentage times home expenses materially exceeds 1,500. Switch to actual and talk to the CPA on recapture. Difference within $200. Take Simplified and skip the complexity. The marginal deduction is rarely worth the documentation overhead at small gaps. Documentation gets built at setup, not at audit. Take the floor plan and measurement the day the office becomes the office. Take photos in plain daylight before any personal items drift in. Save the lease or mortgage statement that year, not the year the auditor asks. Annual utility, insurance, and repair summaries from the actual method election go into the same folder. Reconstruction at year 3 is what coaches lose audits on, not the original claim. A worked example. 12 by 12 office equals 144 SQF in an 1800 SQF home. Simplified. 144 times 5 equals $720. Actual. 144 divided by 1,800 equals 8%. Annual rent $24,000 times 8% equals $1,920. Utilities and insurance at $240. Total around $2,160. Actual beats simplified by $1,440. She picks actual. Documents floor plan plus annual expenses. Reviews with her CPA every December. Stop the video and measure the room. Length times width times $5 is your simplified number, usually under 1,000, often around 700. Open the home office worksheet and run the actual method against last year's rent, utilities, and insurance. If actual comes in materially higher, you have a conversation to schedule with the CPA. Recapture math, not deduction math. If the gap is under $200, the simpler election wins on overhead alone.